This is TreppWire with a special podcast, the European market in both CRE and corporate CLOs. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with our own Andrea Tortora, head of European modeling and content, and Andrew Jacobs, head of structured finance. Welcome, Andrea and Andrew.
Thank you.
Thank you.
Glad to have you this month. As we look at what's happening in the UK, we've seen that stay-at-home orders are now becoming stay local. Give us, as if Joe were here, he'd call this the vibe check. So give us an idea of how the changing rules are impacting what's going on.
Yeah, sure. As you said, the Prime Minister outlined a four-stage plan to lift lockdown restrictions here in the UK, and the goal is to remove all of them by the 21st of June. So the first stage was about allowing the return of students to school in the first week of March, which happened. The next step will be the opening of non-essential retail in mid-April, and then followed by the opening of indoor venues like restaurants or bars, hotel in the second part of May. The time window between each of these stages is just to allow to have enough time to observe the impact of each of these restrictions being lifted and to be able to reverse the course if needed. So far, the cases, if we look at the number of cases, they've gone down significantly, and now we are almost back to the levels that we last seen in September. So definitely good from that point of view. And even in terms of vaccinations in the UK, 37% of the population has received the first dose, while only the 2.5% has received the second dose. And there is the commitment, one of the goals of the government is to make sure that almost half of the population, so around 32 million of people, to receive a first dose by middle of April. So there is a strong commitment, and the situation is definitely improving, and we are all looking forward, if possible, to see a little bit to return to more kind of normal life.
So that sounds great. One consistent theme over the past year has been kind of the diverging response between commercial real estate and corporate CLOs to COVID and the lockdowns and so on. So, beyond the lifting mood of the people and some of the restaurants and stuff, do you think there's going to be a change when it comes to corporate credit?
At the moment, let's say that the liquidity is still in the system, I have to say. And of course, there is still a crucial element, which is depending on the sectors in which corporates are involved, whether it's the retail sector or not. It's anyway important to start to seeing again, it's return to normalcy. To some extent. So, but at the moment, the liquidity is still there in the market, and the central banks, we might be touching on this later on as well, but the overall stance of the central banks in the UK, but even in Europe, I would say, are always aimed at trying to make sure that there is ample liquidity in the system.
So over the last few weeks, the news cycles have been dominated by discussion and concern over inflation. Last week, we reported that the ECB bond buying was going to ramp up in the next quarter to contain bond yields. And this week, everybody's watching the Fed to see their inflation forecast and their policy rate path. Give me an idea of the impact to CLOs and farther afield from there.
As a sort of a recap, we have seen across, I think globally, basically, but mostly in the US, a steepening of the curve over the last month, particularly so in February, and even now on the long end of the curve. And most of these movements were mostly fueled by concerns about possible rise in inflation and also a potential return to a normal condition in the economy. This has had, generally speaking, from the point of view of a bondholder, so if you're investing into a bond, that's obviously negative news in the sense from a market risk perspective, because an increase in yield will translate, everything else being equal, into a decrease in prices. The good thing on CLOs, when you think to CLOs and to some extent also to other asset-backed securities in Europe, is that because their coupon is periodically resetting, it will be resetting in European transactions, but even on US CLOs, it will be resetting every quarter. So that gives a possibility to incorporate changes into benchmark rates like Euribor or LIBOR. In this sense, these instruments are less sensitive to increase in interest rates. Therefore, in relative terms, compared to other instruments, they offer better value. So in this sense, they were not really affected compared to more traditional plain vanilla bonds.
I'm in total agreement. Yeah, I mean, with floating rate, you can even say that CLOs are in a hedge against inflation, right? They're very safe from it. You do have to consider relative value. I mean, if interest rates go up, then a fixed rate instrument might maybe appear more attractive versus a floating rate CLO, depending on where the spreads are and all that. But like I totally agree with Andrea that they're all else equal. They're very well protected from an inflationary environment.
So let's dive into some of the details. And Andrew, if my calendar is correct, the last time we had you on the pod, it was around Halloween. So it only seems fair that we invite you back on St. Patrick's Day. And at that time, you had gone over what you said was a full credit cycle in just a matter of 6 months. And that was fueled by the pandemic, price volatility, ratings downgrades. Give us a little bit of a deep dive into where we are now, and then we can break down into some specifics.
Sure. Yeah. I mean, it was essentially like a pause in the bull market, and we're back in that bull market in a lot of ways. I mean, there were some rising defaults and some downgrades on the corporate credit, which made the fundamentals look a little worse as time went on and into today. But there's been a search for yield for many years now, people fighting for assets, and that continues. We saw some interesting kind of technical side effects of that recently, where you saw resets in the CLO market pricing tighter than new issue, where you have people who are asset managers or people running a portfolio who are desperate to hold on to the paper they have already, let alone being able to buy new paper. So it's definitely back in that mode where people are heavily investing in whatever they can that has a decent yield, and CLOs are no different. And unlike CRE, the corporate credit hasn't been hit quite as hard by the pandemic. A lot of businesses doing completely fine, and it's really just specific sub industries that are feeling the pain.
I agree with Andrew, and I would add that I think the CLO as a global asset class, so including looking at both US and European CLOs, really managed to weather the storm last year. They really showed capacity really to adapt to really challenging market conditions, and it was already a good start of 2020. Then the pandemic, and there was the market sell-off in March, and the massive wave of downgrades that Andrew was also mentioning earlier. But notwithstanding, there was a really great comeback towards the end of the year, and we could look at it in terms of prices or in terms of credit risks. Things definitely improved. Of course, there was also, thanks to the stimulus and the accommodating monetary policies, it was a combination of different factors. But definitely, as an asset class, you really managed to basically protect its value. What I wanted to say as well, just looking at the European CLOs during 2020, we have seen the emergence of some features in the European market, which were maybe present in the US already, but not definitely in Europe. And it was, again, showing this way of capacity to adapt to the market conditions. So first of all, we saw what they're called print and sprint deals, which were not present in Europe up until last year. So print and sprint deals are those deals where, unlike typical transactions, there's no warehousing, but actually the proceeds are then used by the managers to go and buy loans in the market, primary or secondary market. And there was the right moment because a very general level prices were still low. So there was a possibility for the managers to buy loans at good prices. We also see static CLOs being brought to Europe by a manager. Again, static portfolio was a way to make sure that deals could be done when investors were a little bit nervous about and unsure about the prospects of recovery. So the idea to have a static portfolio was seen as basically as a plus. We have seen also deals with delayed draw features, so where, for instance, some notes are included, but there are not really issues at the time. And again, because they were maybe too expensive, but it was a way also for the managers to make sure that they could rely on them in case of need. And other features that we saw last year as well was slight variations to the usual format in post-financial crisis. European CLO was a typical transaction with 4 years of reinvestment period and 2 years of non-call period. That was the typical, let's say, architecture that we saw in Europe. But what happened last year is, because of the challenging market conditions, we saw there was a lot of interest towards short-dated paper. So there was a decrease in investment periods. So we saw deals with 2 years or 3 year investment period and 1 year non-call period. And again, this was a way to basically a sort of win-win, a way in the sense that investors did not want to be exposed too much to the uncertainty and the dynamic nature of our investment portfolio. But on the other hand, the equity note holders wanted to still be the possibility within 1 year, rather than typically 2 years or 2.5 years, be able to reset the liabilities, because market conditions were not really great at the moment. So we have seen different variations, which again showed how it was possible to put all the different parties together and still be able to print new deals. In fact, actually, we have also seen recently, over now in 2020, even 2021, feature that again was not present in Europe. So even the extended now the investment period up to 5 years with the recent transaction.
Yeah, 5 years has been the standard in the U.S. for years now. So it's interesting that it made its way over finally. But I mean, with last year there was, another thing in the market with supply is last year there was really almost no refinancing going on in the CLO market, which is really, really unusual. I mean, the deals they do have 5 year or 4 year reinvestment periods, but they typically only have a 1 or 2 year non-call period, which is pretty quick into the life of the deal. And the managers are pretty incentivized to refinance, because they're primarily earning money through fees. So if they can extend the deal, they're always happy to do that. And with no refinancing almost at all last year, there's pent up demand, or pent up supply, I should say, where there's a lot of deals that would have refied but didn't. And if the environment is right now into 2021, you could see a market dominated by refinancings, at least potentially.
And I would say that the emergence of these features in the European market, some of these coming from the US, is also linked to another thing, to this recent trend we observed over the last couple of years, or the last few years, of US managers coming into Europe as well. So also bringing some of the structures across basically the Atlantic. And so in terms of managers, if we look, for instance, what we have seen as of the end of last year, so as of December 2020, the number of European managers active in the European market market had gone up by, I'd say, around 10. So the year now it's about 60 managers active in Europe. We know that European market is smaller than the US ones. If we look in terms of asset under management, it's a kind of ratio of 5-1. It's not the same sort of ratio in terms of managers, where here we are talking about. It's always changing over time, but now it's more about maybe 2 or 3-1, let's say, in terms of managers. But as I say, having more and more US managers coming into Europe is also leading to a sort of more homogeneity also in the structure we see over here.
And looking at issuance numbers, where are we at for issuance this year compared to last year?
2021 so far has been really great. It's a really great start of the year. So we have seen a lot of activity. Looking, for instance, at Europe, end of February, it was slightly less than 20 billion of paper issued. And this including the new issue deals and repricing, or almost on a ratio of 1-2, and repricing include refinancing and resets. So really very active market, particularly if we compare with last year. Just to give an example, at least, you know, as far as European market is concerned, in 2020 we saw only volumes around 22 billion, and now we are almost at 20 billion. And this most of it is driven by this intense repricing activity. We have been mentioning earlier, some of the all the deals typically come with a non-call period. As we said, the norm was, at least in Europe, it was a 2 non-call period, 2 years for non-call period. That meaning that essentially all these, for instance, that closed in 2019 or even earlier, are actually candidates for a refinancing this year. And some of these actually were even candidate last year, but the conditions were not favorable at all. And in addition to those, we also have deals that closed last year with this 1 year non-call period. So again, there are expectations for a continuation of this trend for the rest of the year, and at least regarding the European market. And I think this is really, of course, absent any major market shock in the rest of the year, I guess this can really be a very positive year for CLOs, at least for European CLOs, but we are seeing something similar in the US as well. Andrew, I think you can confirm.
Absolutely. I mean, I think it's just as you said in the US, maybe even slightly better, just because in the US we have a little bit more participation from the Japanese banks, who are always trying to buy as much as they can of AAA. So that affects things a little bit and makes issuance easier. But for sure, I think it should be a positive story this year, unless something changes.
And what about spreads?
Spreads, again, I mean, this goes hand in hand with what we were saying before. So spreads have been tightening. So we are almost back to the lows experienced 3 years ago. So recent transactions in Europe, new issue deals were, for at least talking about the senior, the AAA tranche, so the senior tranche, the most senior tranche. So the spreads now are around 80 basis points. Just to give some terms of comparison, at the height of the crisis in March, April last year, they reached around 150, 160, and 170 bips. At the end in December, they were more around 100 bips. So there is significant tightening. There are now, given the significant supply currently in the market in terms of new deals, there are now not concerns, but people are talking about the possibility that maybe this trend can a little bit maybe pause for a little bit. Maybe spreads might stay flat for the time being. On the mezzanine tranches, we have seen recently some slight widening, even though they are anyway still on favorable terms.
So looking at commercial real estate quickly, could investors be looking for new opportunities? We've talked about here in the US, distressed assets being of primary interest. What's going on your side of the pond?
We have been talking and covering in our weekly update for our readers about latest developments. There are different, let's say, different sectors, different property types are meeting different, let's say, interest. And retail has been, unfortunately, it's not been a great couple of years for retail sector. While on the other hand, there is always a strong interest for warehousing and also interest for offices. There is a lot of discussion about what does the future look like for offices, and we have covered in the latest market updates. We are talking about a recent transaction that has happened in Italy, in Milan. So with Blackstone, who has sold a very historical building in the heart of Milan to private investors for basically a price which is even slightly above the asking price. And this is one of the more elegant office spaces in Europe, hosting JP Morgan's and even the first Starbucks outlet in Italy, which, by the way, I have to say is very close to the first office where I worked many years ago in Milan. So at the time, Starbucks was not around. Starbucks only entered the Italian market in 2018. However, it's a very historical building, very nice, and also the cap rate was estimated to be around 2.8%, which is definitely reported to be a record for that segment in Italy, in Milan. So that shows how still there is interest, and how maybe we could see a sort of bifurcation or differentiation in the real commercial real estate market in terms of location and in terms of the value of these properties. Whenever we were talking about trophy buildings or historical buildings, there's always maybe going to be interest from investors.
What the heck is a Starbucks doing in Italy when you can get a good cup of espresso just about everywhere?
And I had a related question. Like, what do people order in Italy when they go to a Starbucks?
That's a good question. I actually haven't had the chance to try a Starbucks in Italy, and I happened to be in Milan a year ago, and I remember passing by that building, and I was really impressed by the style, but I didn't actually try anything. I didn't even enter. But definitely, I think it's kind of mixed feelings. I guess you have large part of the population who are really maybe not so open to try coffee at Starbucks, but at the same time you have, I guess, the new generation. They are also keen to be part of kind of.
It's for the tourists.
Yeah.
I think it's for the American tourists that are like, I don't know where to get a coffee, which is ironic in Italy, but there's the Starbucks. So with that, we'll close the special podcast. Thank you, Andrea and Andrew, and thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well. All right.